All right, team, you have seen it out there and it's time for me to address it. All the clickbait headlines that say, higher credit borrowers to be punished, Biden redistributing fees across and punishing high credit borrowers. Guys, this is clickbait. This is intended to get you to click on it and cause a rise. The new loan level pricing adjustments, or LLPAs, that the GSEs, that's government sponsored enterprises, Fannie Mae and Freddie Mac, let's debunk all of the myths that are swirling around these right now. Let's talk about what's really going on here. So first things first, we have to start with what is an LLPA. And just FYI, I have been talking about this. It has gone out in email blasts, etc. for a while. So this isn't news. It's just gone viral on the internet with click-worthy headlines, okay? Let's start with what is an LLPA. LLPA stands for Loan Level Pricing Adjustment, okay? Basically, an LLPA is additional costs and fees that go along with a conventional loan, not any other type of loan, a conventional loan based on risk factors. Guys, this isn't new. This ain't a newsflash. LLPAs on conventional loans have been happening since 2008. And quite honestly, that's why I haven't done a video on this yet, because I really did not look at this as a huge deal. So when you're seeing this clickbait out there scaring your clients or scaring you, just know this has been going on for a while. I don't know anyone that's in the industry. Perhaps you remember me talking about the LLPA increase last year for second homes and investment properties. Do you remember that? Last spring, they added extra fees for people buying a second home or an investment property. That happened last year. Why is everyone in uproar about this new LLP adjustment? We're going to talk about it a little more here. Typically, an LLPA is, as I mentioned before, it's risk-based. So we're talking about there'll be adjusting factors for higher LTV, lower FICO, occupancy type, like if you're not living there, you are more likely to default on your loan, so it's a higher risk, so there's more fees involved. Other LLPAs that are already out there are property type. If it's a condo, is going to be a different LLPA than if it's a stick-built home, or if it's a manufactured home. There can also be LLPAs on loan size, loan type, how much you're putting down, or your LTV, which I think I may have already mentioned. These have been going on since 2008, so this is not new, not a new situation. We do not need to be up in arms about this. So the LLPAs, that the changes that are coming to the already in place LLPAs are going to impact both lower and higher credit score folks, and they're going to be also based on debt to income ratio. Now, nobody go out there and lower your credit score on purpose to try and get benefit from these LLPAs, guys. There is really no scenario where a borrower is going to get that much better of a deal or that much different of a deal with a lower FICO score than someone with an 800 FICO score. Okay, so stop that. Please do not lower your FICO to try to get a better mortgage rate. That is not going to work for you. The GSEs, Fannie and Freddie, have started to do some really great things as well with this change. One, they're going to be waiving the LLPAs on affordable products. That's your home possible, your home ready, products that benefit lower income borrowers with conventional loans, okay? They are going to be increasing costs based on higher credit and lower LTV options. Listen, yeah, okay, that sounds like, oh, we're punishing higher credit borrowers, but when you actually look at the matrices, it is not that big of a deal. You are still going to get a better interest rate if you have a higher FICO than if you have a lower FICO. We're just trying to decrease the gap, okay? I'm gonna show you some numbers here in a minute so that way you can see the decreasing of the gap. The other change that's coming is debt to income ratio. So this one, a lot of folks are up in arms about. And this is talking about happening on August 1st, that delivery of loans to Fannie Mae and Freddie Mac for August 1st. So it's going to start happening prior to that. This means higher LLPAs for borrowers with over a 40% debt to income ratio. So if you remember what a debt to income ratio is, that's all of your monthly debts divided by your income, debt to income, okay? So for borrowers with more than a 40% debt to income ratio, you may be facing higher LLPA pricing. That doesn't necessarily mean a higher rate. It just means more fees at closing, okay? Now, why is this important? This is important for you to know as real estate agents because you need to make sure more than ever that your client is with a knowledgeable loan officer, right? Because a lot of times loan officers can be a little bit lax. And in case you didn't know this, to become a loan officer, you don't need any training. You can go work at one of the large banks and get an NMLS number and originate loans day one. Terrifying, right? So it is more important than ever to work with a loan officer that's great at their job. For example, being able to find more income to use for that borrower to make sure their debt to income ratio goes below 40%. That's huge. A lot of times we can use bonus income, child support income, commission income, but sometimes that stuff is left out because it's not needed to qualify for the loan. Well, now we need to make an additional effort as loan officers to make sure we're including all of the income. Does that make sense? So that way the debt to income ratio is lower. The other thing that loan officers will need to do, and you need to work with a great loan officer, is they need to review the credit report with the clients. We need to make sure that all of the liabilities that are actually on that credit report belong to that borrower, because now it's going to be more important for that borrower that their debt to income ratio is going to be below 40%. Again, guys, LLPAs, not a new situation. Just as loan officers, we constantly have to be in the loop with what things are changing for our borrowers. And this is why, one of the many reasons why I say to my real estate agent partners, please, for the love of the Lord, do not talk mortgage with your clients. You need to have enough to be dangerous, and then you need to refer it out to the lender and let the lender answer the questions. Another thing that we can be doing to help borrowers with this DTI change is we need to pick the right mortgage insurance for the clients, guys. We have to be aware of what we're doing so that way we can try to keep that debt to income ratio lower. Now, just a little thought process on this debt to income ratio LLPA. None of the mortgage industry wants this either. But the logic here is that with clients that are above that 40% debt to income, the GSEs are looking at those as higher risk borrowers because their debt to income ratio is higher. The MBA is fighting this. Nobody really wants to see this come into play. But in no point in time did I say, oh, good credit borrowers are going to pay 1% more for their interest rate. No, that's not how this is going to work. Okay. All right. So I'm also going to go through here and just go through a couple of graphs that Mortgage News Daily posted. If you look at this chart with me, this is showing the difference in the LLPAs before and after the change. The red section equals rising costs. So in the no cash out refinance, the cost to get that mortgage is going to be those add-ons, those LLPAs that have already been there to a degree are going to be higher in that 80 to 85% loan to value section, with credit scores in that mid 700 range. Do you see that? But they're actually making it less expensive there for people to refinance in the lower credit. But in no way is that a 1% difference, okay? We're just lowering the gap between the two because the original LLPA for those lower credit score borrowers was a lot more. So guys, people in this green section, if you look at the green section in this no cash out refi section, or even if we look at the next slide, which is the purchases, the change from previous, you can see that they've got a lot of green in that lower FICO score bracket. Do you see all that green? That means the cost to get a conventional mortgage is going down. But I'm going to tell you what. In that section, the 680 and below section, where they are making it less expensive to get a conventional loan, let me tell you, a lot of those clients in that section, in that 680 and below, they're not getting a conventional loan anyway. This isn't even going to really be a thing. Now, maybe they may be getting a conventional loan, but more than likely, if you're in the mid to low 600s, you're probably getting an FHA loan, some other type of loan than conventional. So don't look at this as a punishment for good credit buyers. You have to look at this as a decreasing gap between the two, because the LLPAs to get a conventional loan at a 650 credit score were massive before, okay? So one, you can see that the changes here are not substantial. As the general public, you're probably not even gonna notice these changes. I'm not gonna lie. You're probably not even gonna notice. And real estate agents, you're probably also not even gonna notice. The reason this has become such a thing, again, is because it was made political and went viral. This was announced back in January. So this whole situation, again, guys, PM me, DM me, email me, text me, call me. I will send you the sources of the information that I'm getting. But this is not something that we need to panic about. This is not something that you should go and damage your credit to get a better interest rate. That's all baloney. I hope this helps. Please DM me if you have any questions. I appreciate y'all.